Welcome back, investors. Jake here. If you've recently subscribed to my channel for my Russia-Ukraine content, I'll have another update video for tomorrow. But if you've been subscribed to my channel for longer than 2 months, you know that primarily I talk about finance and investing topics. And in this video, we've got to talk about and do an update on the stock markets. It's a bloodbath today. Dow Jones down 2.8, S&P down 3.2. NASDAQ down 4.6. I think this is the worst drop so far this year, and it's looking pretty bad for the markets year to date. S&P is down 13%. A bear market is a drop greater than 20%. Potentially, it's coming. And it's been brutal the last 5 weeks. I'm sure you've been feeling it as well if you check your brokerage account or 401k on a semi-daily basis, but according to all the technical indicators, the S&P fell into the oversold range back on April 8th, and for 5 weeks we've just been languishing down here. And I've been, trying to specialize in technical analysis, and anytime the market gets oversold like this, we maybe spend a week or 2 weeks down there tops, and then there's a bounce, a rally. Even if we're not going to new highs, there's still a bounce or a rally. We're not experiencing that. The S&P, well, this is State Street's SPY, but the S&P 500 peaked on March 29th, and it's just been going down and down and down. The technicals, what I see is this highest high, lower high, so I'm expecting there to be a rally, a bounce, some kind of positive momentum where potentially we'll get back to maybe an S&P value of 4,500 before the market just sells off again. But I think with Federal Chairman Jerome Powell's interest rate schedule of maybe 50 basis points every month or two or so for the rest of the year, basically until interest rates hit 3.5%. I don't know. This is fascinating from a technical standpoint because this level of the S&P being at 4,150 goes all the way back to April of last year. So an entire year's worth of gains basically have been wiped out on the market. It is 13% from the heights, but we're basically at break even over the last 12 months. And the S&P reached this level on February 24th, hit it again March 8th, hit it again March 14th, and it's been crashing through this, up and down through this line the last 4 trading days. So potentially is the broader market going lower? And I think it is. I definitely think the S&P is going to go below 4,000 at some point in the next 3 months. The question is, will there be some kind of rally? And I was hoping yesterday was it. I was watching Federal Jerome Powell's statements live on television, and this is wild. I'll link this clip down below. But as soon as a CNBC reporter asked him, is 75 basis points possible, Jerome Powell said, we're not considering that, it's not possible, or it's not something we're actively pursuing. As soon as he said that, the S&P 500 took off. You can watch it in real time. This is a 3-minute clip. The second those words came out of his mouth, the S&P took off, and I think it was up about 3% yesterday. So even though the Fed raised interest rates by 0.5 percentage point, the market interpreted this as good news that there wasn't an increase of 0.75. Potentially in a month or two, there won't be a sudden increase in 0.75. However, that stock market rally we experienced in the last hour and a half of trading yesterday completely evaporated this morning as either active traders decided to sell out before market open, or other large funds interpreted that bounce as a good time for them to recoup some of their losses before they pull out of the market themselves. There's a lot of craziness going on, but what is driving these rate hike increases, everyone says inflation. And yes, but what is causing inflation? And a lot of it is due to labor costs. This article is from May 3rd. Job openings and numbers of people quitting hit record highs. It's the pit of despair for employers. There were a record 11.5 million job openings as hiring cooled and quitting soared in March. So what's happening here is, yeah, I mean, you can get a starting wage at $18 an hour at a fast food joint in many parts of the country. There is just so much competition for labor. Employers have to keep raising hourly wages, keep raising and improving benefits, and then they have to pass those costs on to consumers by raising the prices for their goods and services. So this is deliberate. This is how this is how capitalism works. So the Fed, to cool inflation, is raising interest rates, which makes it harder for people to borrow money. If people have less money to spend, then consumer demand will collapse, meaning employers don't need as many employees to fulfill goods and services demands. So this is, I mean, it's right here on the federal funds effective rate chart for the Federal Reserve's website. So these shaded regions are recessions, contractions in the GDP of the American economy. Every time the Fed raises interest rates, triggers a recession, and then the Fed lowers rates back down to zero. Raise interest rates, recession, Fed rate goes down. Raise interest rates, recession, Fed rate goes down. Raise interest rates, recession, Fed rate goes to zero. Raise interest rates. This is the only time that actually didn't happen. The Fed back in 2018-19 started cutting rates, even though there wasn't recession, but inflation was low anyways. So potentially they shouldn't have been raising it to begin with. So everyone in the market is pricing in that a recession is inevitable. A recession is coming. You can't fight the Fed, both when it's buying up the bond market to prop up the stock market, but also you shouldn't fight the Fed when they're deliberately raising rates to kill consumer demand, to cool the jobs market, to control the cost of labor. Also supply chain constraints, but I think the cost of labor is what is most contributing to inflation at the moment. Additionally, the Federal Reserve has stopped buying U.S. Treasuries, and it's pretty shocking that they were still buying up until March, given the inflation data we had, even in December, January, February. So the Fed is now unloading some of these bonds every month. What does this mean? It means that the yield for government bonds or whatever has to go up. And it is. Look at the rate of increase of U.S. Treasuries, currently 3.1%. Why does this matter? It matters because if you can guarantee yourself 3.1% on your money every year for 10 years, then you'll buy bonds. If you buy bonds, you're not buying stocks. The only thing that makes the stock market go up is more people want to buy than sell. Seller demand is less than buyer demand. So when capital flows to U.S. Treasuries, it doesn't go to the stock market. So this is gonna keep going up potentially as the Fed, I think, is done buying government bonds, and the more they unload, probably the higher these yield rates will go. If you think the stock market by the end of the year is going to be down 10%, would you rather have positive 3 or be in an S&P 500 index fund and have negative 10? That's a swing of 13%. I think potentially what is causing such a large sell-off this morning is bad earnings reports from e-commerce stocks. E-commerce stocks plummet as consumers pull back online spending, and these stock charts are devastating. Etsy down 65% over the last 6 months, Shopify down 73%, eBay down 35%, Wayfair down 70%, and then the biggest of all the online retail sellers, Amazon, not even in this environment could they pull it off. They're down over the last 6 months 33%. So with the e-commerce stocks, there's a couple things happening here. One, the year-over-year comparisons are just devastating because so many people a year ago were just sitting at home ordering stuff online because of the pandemic. So one, people are going to physical stores, physical retailers again, and you can see from transactions through Visa and MasterCard's data, this is showing that people don't have to shop online anymore because they can go to a physical store. And I think to the most part, a lot of not probably a majority, but a lot of people do prefer in-store shopping over online shopping. So it's just a tough market, and the year-over-year comparisons with the first and second quarters of 2021, it's just going to devastate all of these companies. They can't sustain this level of growth. Amazon's revenue was up, but it was up at a lower rate from a year ago, so it makes it look bad. All the multiples contract. All right, let's get to my Schwab accounts, and it's decimated year to date, down 25,000 or about 42%. When we look at my positions, everything was looking much better yesterday. Maybe I should have just sold out and called it quits, but I'm not going to panic sell. Potentially, with these contracts expiring in January of 2023 and September of 2022, I'm not going to panic in May. Potentially, that bounce is still coming, and it'll get to this point. I've drawn it in for you guys. And even HCI, I'll quick mention this. HCI is the only thing positive today because they gave their earnings report, and TipTap grew its revenue premiums from 44.8 million to 86.2. They basically doubled. So HCI beat on earnings per share. It beat on revenue projections. Company's doing great. How does the stock market reward it? Up 1.9% is what it is. So I think the large money managers and the billionaires, they've turned on this market. They rode it up once again as the Fed kept rates at zero. They know what's happening on the macroeconomic scale with the Fed raising rates until basically enough companies go under to free up labor so that employers don't have to compete as much raising wages and benefits. So here's Paul Tudor Jones saying that he can't think of a worse financial environment for stocks or bonds right now. The only reason for a guy like Paul Tudor Jones to do a media tour just saying the stock market is bad is if he isn't short the market. So I'm sure that this guy who's a billionaire has a large short position on certain stocks or the whole market in general, and he will financially gain from the market going down. It's the only reason why he would be making press appearances just to basically say things are bad. Additionally, Bill Gates apparently has a $500 million short position on Tesla. Elon Musk is not happy about this and has been basically, disparaging Bill Gates on Twitter. So I think there are a lot of very wealthy individuals who see a downturn happening and they're trying to make money on it. But if they have short positions, then they're not going to be buying stocks in general. So for them, it actually benefits them financially to tweet out negative stories and to say things are bad and it's all going down. So 2022 is not looking like a good year to be buying stocks. Once again, with how these earning reports are given, it's always about year-over-year comparisons. So potentially 2023, the market will have a bounce back. So what do I want to do in the short term? I don't want to liquidate my positions for a loss. I want to give them more time. But I also just think making daily content about stocks doesn't serve my best interests anymore as well on this YouTube channel. If you've been with me for a long time, I greatly appreciate your support. Hopefully I've given you positive value by sharing with you knowledge on fundamental analysis and technical analysis. But since I started talking about the Russia-Ukraine crisis, I've gained almost 40,000 subscribers in the last 3 months. And if you've been with me for the last 3 months, you know the reason why I started talking about the Russia-Ukraine conflict is because I had call contracts on General Dynamics. And you can go back and watch that video when I sold those contracts after General Dynamics share price spiked. And I said, I don't think the war is going to happen. It would be incredibly stupid for the Russians and for Putin to go into Ukraine. That would be a disaster, a quagmire, a public relations nightmare, a financial disaster for the country. And we're only 2 months into the war, but I feel like I've been pretty accurate with my predictions. Now, I predicted that Russia wouldn't do it because it would be stupid. And I guess the world is learning how inept and stupid Russia really is. So if you're not familiar with my background, I served in the Air Force as a nuclear and missile operations officer for 6 years. My bachelor's degree is in political science. My master's degree is in international relations. I do think I can do a lot of good making content and making videos to help people understand exactly, the conflict currently occurring in Russia and Ukraine. Its relationship and history with NATO, its relationship and history with the collapse of the Soviet Union. There's a lot of interesting videos that I think I can make on this channel. And in the near term, that's what I want to focus my attention on. And I can't fight these views, guys. My video from yesterday got 97,000 views. My video from 3 days ago got 250,000 views. My video from last week got 375,000 views. So as much as I enjoy talking about the stock market, finance, and investing, my last stock market video got 13,000 views. So I'm getting 10x more views by focusing on topics related to international relations and the military and this conflict in Ukraine. So I want to give this a shot. I want to start making those kinds of videos and develop a format, grow my audience, and I think this will do me some good, and I can make some videos that other people will find informative and entertaining or inspiring. This is crazy what's going on with the world. It really is potentially the prelude to World War III or a nuclear armed conflict. It's like the perspective here, I think, is lost on a lot of people. Potentially how dangerous we are to a lot of disastrous scenarios. I'll talk about it in a future video, specifically what I'm referring to, but it's a crazy world right now. And I think the stock market is not going to respond positively to it. Okay, everyone, that's all for this update video. If you're still watching, then you're a true supporter, a true subscriber. I greatly appreciate all the support you've given me over these years that I've been making YouTube videos, and I hope you'll continue supporting me as I try and shift focus on this channel to more international relations topics. Till the next video, take care, be safe.